As a portfolio manager and chief strategist, I have to force myself out of my personal bubble and explore what others have to say, if for no other reason but to challenge my own point of view. Groupthink is a dangerous outcome for those who make decisions by committee. But so is tunnel vision, where you shut out any input that doesn't reinforce your belief matrix. As professionals or investors looking to up their game, we consume as much data as we can, tapping a collage of analysts, media news providers, pundits, and of course, hard financial and economic data. The news cycle never sleeps, people. It's a never-ending task that gets repeated again and again. So what did we learn last week? Is the back-to-back weekly losses the pause that refreshes, or is it the start of something a little more sinister? Let's find out. Welcome to The Money Runner. I'm David Nelson. So what did we learn? We learned a lot. Markets are desperately trying to broaden the rally. In fact, over the last 4 weeks, on a factor basis alone, you can see that momentum-driven performance has been slowly giving way to value and or dividend-paying stocks. It's a close call, but energy is now the leading sector year to date. And when was the last time you saw financials on the leaderboard? Technology is now giving up some ground. Ultimately, broader participation from other sectors and market caps will go a long way to sustain the bull market. AI will likely still be the prevailing theme. We discussed long ago my belief that some of the biggest beneficiaries of AI will be the thousands of companies that use the technology, or the secondary players that play a pivotal role in support of all the usual suspects, including mega-cap giants NVIDIA, Microsoft, Meta, Alphabet, and someday even Apple. Goldman's note from David Kostin this week suggests one solution to extreme equity market concentration is investing in stocks throughout the AI value chain. I couldn't agree more, and that concept can take many forms. Here's my advice for the C-suite. Just about every person on the planet, certainly every investor, has heard about or explored the benefits of artificial intelligence platforms. Millions are already using it, even if they don't know it. You're not going to wow us with the fact that you have ambitious plans for the technology and that it's going to increase revenue and productivity while at the same time reduce costs. In fact, if you're a CEO without an AI blueprint, you should be fired. But stop talking about it unless it's going to boost your bottom line right now. In other words, underpromise and overdeliver. I bring this up because in 2 weeks, we'll be at the end of the quarter, and a short time later, we'll be knee-deep in another earnings season. Once the 31st hits, you can start the clock on when the first pre-announcement releases will hit the tape. Talking about AI isn't going to save a less than expected quarter this time around. On Friday, JBL reported earnings that go to the heart of what I'm talking about. First of all, JBL is a great company, and in many ways one of the unsung heroes for technology investors. In fact, even with Friday's 16% fall, it is still up significantly more than the S&P 500 and the technology sector over the last year. Long term, forget about it. JBL is a massive outperformer. But even the mighty stumble, and this quarter wasn't meant to be. It happens. This year's a transitory year for the company as they sold their mobility business. Maybe that was a distraction, or in fact, business just slowed, but management was forced to lower guidance. While the conference call with analysts discussed most of the lines of business, AI was clearly the focus as it was mentioned repeatedly. In fact, it was mentioned so often that Rupla Bhattacharya, analyst from B of A, joked about it with CEO Kenny Wilson, saying he lost count. I lost count too. I had to go to the transcript this morning to check it out. All in, I counted 46 mentions of AI during the earnings call. I'm not picking on JBL, or at least I don't mean to be. But this is likely what we're about to see in the coming earnings season. If we are truly in the next leg of the AI revolution, investors are going to want to see some food on their plate. It's not going to be enough to talk about the promise of AI. How is it adding to financial targets today, not tomorrow, but right now? And if it's too early to harvest the potential, be honest about it and give us achievable targets and a realistic time frame. In other words, where's the beef? I hope the Money Runner podcast struck a chord. If it did, do us both a favor. Hit subscribe. It doesn't cost money, but it does cost time. And don't forget to visit our sister site on Substack, DCNelson123 at substack.com. Thanks for joining. I'm David Nelson.